free money, not clickbait. Sorry for my appearance, it's getting late, but I wanted to bang this video out before going to sleep. Discover how to double dip on your capital using portfolio margin. The ultimate capital efficiency hack for serious options traders. The problem: your cash is sitting idle. The cost: most traders leave thousands in cash sitting as collateral for option selling. That money earns 0% at many brokers, or barely 1% if you're lucky. Every dollar locked up as collateral is a dollar that could be working for you elsewhere. The goal: what if your collateral could earn interest while you trade options simultaneously? That's not a fantasy, it's exactly what sophisticated traders do every day using portfolio margin. Portfolio margin, the game changer. It's a risk-based system. Unlike standard margin, portfolio margin evaluates your entire portfolio holistically, considering hedges and overall risk. Stress testing. The system runs scenarios asking, what if the market crashes 15%? How much does this specific portfolio lose? Massive leverage. Much lower margin requirements, often 6 times leverage or more compared to standard Regulation T account. Regulation T, which is standard, fixed percentages, 50% for stock buying power reduction, specific amounts for spreads, which is the width of the strikes less the credit received. It's rigid, one-size-fits-all rules. It doesn't account for hedging or diversification, and you get lower buying power. With PM, it's much more advanced. It analyzes concentration risk and portfolio volatility, considers your hedges and correlations. It's adaptive to your specific positions, and it drastically increases your available buying power. The bottom line: portfolio margin recognizes that a well-hedged portfolio is less risky than isolated positions, rewarding sophisticated risk management with capital efficiency. The strategy: the double dip free money hack. Buy cash equivalent ETFs. Take your cash and purchase S-GOV or BOXX. These assets earn 4 to 5% yield safely. Personally, I prefer BOXX because being in the United States, it's a 1256 contract, so it's more tax advantaged. These securities, like S-GOV or BOXX or BILL, are often 90% marginable. They only use 10% of your buying power, leaving 90% available for trading options. Use that 90% buying power to sell options and collect premiums as usual, while your ETFs generate yield. Double your returns. Earn 4 to 5% on your collateral plus your normal options trading returns. That's free money on capital that would otherwise sit idle. Why this works: the interest loophole. You're not borrowing, you're pledging. Here's the crucial distinction. When you use buying power to buy and sell options, you're not borrowing cash from your broker. You're simply pledging your S-GOV or BOXX holdings as collateral. No borrowing equals no margin interest charges. Your broker accepts the ETF as security for your options positions, but you keep earning the 4 to 5% yield on those securities. It's a true double dip. Plus, unlike with Regulation T, you're not paying margin interest, so you're saving money. 0% margin interest because you're not borrowing. 90% buying power still available to trade. Tax advantages. BOXX ETF, the tax advantage choice. BOXX spread structure. BOXX uses sophisticated options box spreads to replicate T-bill returns with remarkable precision and safety. It also receives Section 1256 tax treatment. BOXX often qualifies for favorable treatment: 60% long-term, 40% short-term capital gains. It's perfect for portfolio margin. It's highly liquid, marginable at 90%, and ideally suited for sophisticated accounts seeking capital efficiency with tax benefits. Before I learned about the BOXX ETF, I used to manually set up box spreads using SPX that were 2 to 3 years out. The problem is that the bid-ask spread differential is so wide when you go out that far in time that sometimes your broker has problems calculating the margin requirements on those positions. As a result, it's much safer, in my opinion, to simply buy BOXX. The catch: this isn't for beginners. There's a minimum account size. Most brokers, Schwab, TD Ameritrade, Interactive Brokers, tastytrade, require $125,000 to $175,000 minimum to qualify for portfolio margin approval. You also need the highest options level. You'll need approval for level 4 options trading or the works of some brokers. This is reserved for experienced traders with proven track records. Sophistication is required. Brokers evaluate your trading experience, financial stability, and risk understanding. This is a privilege earned through demonstrated competence. I believe that many brokers are going to give you a test in order to qualify for portfolio margin. I know that with E-Trade, the test is about 15 to 20 questions, and I believe you have to get a 90%. Now, using AI, it's very easy to get those questions right. However, 5 to 10 years ago, the test was actually pretty challenging. Risk management, use power wisely. Critical warning, just because you have 6x leverage doesn't mean you should use it all. Portfolio margin is a tool for efficiency, not reckless gambling. Smart guidelines. Never use more than 30 to 40 to 50% of available buying power. Maintain diversification across underlyings. Keep your hedges in place. PM rewards hedging. Monitor portfolio-wide Greek exposure daily. Leverage amplifies both gains and losses. Please do not be greedy. My own personal opinion, I think that as long as you have 50% available buying power, you have hedges in place, and you're not overly concentrated, so that way you're not subject to high correlation risk, I don't think you need to monitor your Greek exposure on a daily basis. Because by making sure you have enough available buying power and you have hedges in place, and that you're not overly concentrated and overly correlated, then the Greek exposure will take care of itself. The bottom line, true capital efficiency, 4 to 5% safe yield plus trading returns equals quote-unquote free money on idle collateral. By combining portfolio margin's capital efficiency with cash equivalent ETFs, you transform dead collateral into an income-generating asset, all while maintaining your full options trading capacity. It's the ultimate double-dip strategy for sophisticated traders, and you're not paying margin interest. Disclaimer, this presentation is for educational purposes only and does not constitute financial advice. Leave your comment and questions below. I try to respond to every comment, and if you like this type of content, then please drop a like on this video because it helps YouTube push this video out to more people.